let's get right into our definitive market analysis of a massive week in insurance capital allocation. Over the next few minutes, we're unpacking exactly how and why over $8.3 billion moved in just a matter of days. This isn't just routine market activity, it's a fundamental restructuring of where value sits in the risk transfer chain.
We're tracking a declarative $8.3 billion in disclosed capital deployed across 6 primary transactions this week. The sheer scale and velocity of these deployments signal a major strategic shift happening right now among legacy carriers and private equity alike.
This capital is precisely following 2 distinct patterns. First, a transition from public market valuation arbitrage directly to private ownership for high-performing specialty assets. And second, the direct integration of specialized technology and proprietary data right into capital platforms. The era of simply buying premium volume is yielding to a focus on acquiring distinct, deeply integrated capabilities.
Deal 1. Munich Re and At Bay. We begin with Munich Re's $575 million acquisition of the cyber InsurTech At Bay, converting a 9-year cedent relationship into direct ownership.
The price anchors on a stark 57% valuation reset from At Bay's 2021 peak. This establishes a highly rational 2x premium multiple for a scaled specialty underwriter. Both of these facts are true at once, which is exactly what the InsurTech valuation reset looks like when the underlying business is structurally sound and generating real underwriting profit.
The structural logic here is critical. By buying its own cedent, Munich Re upgrades from viewing historical claims data as a reinsurer to directly accessing continuous, real-time security telemetry through full ownership. They already had the premium. What they just bought was the proprietary data layer to see inside the risk before a breach even occurs.
Deal 2. Steadfast Group. Moving over to Australia, the largest broker network signed a binding $7.7 billion Australian dollar acquisition deed.
Defining feature of this transaction is the split buyer structure. MWins takes the underwriting agency operations, while KKR and Dragoneer take the retail brokerage. Selling the 2 halves to different owners extracted a massive 51.9% premium. This proves that global private capital continues to price broker networks well above what public markets are willing to pay. Breaking apart the value chain unlocked billions in hidden equity.
Deal 3. Standard Life. Over in the UK, Standard Life established a £2 billion pension risk transfer capital partnership with CVC, PGIM, Goldman Sachs, and MS&AD.
The crucial constraint in this specific market is balance sheet capital, not market demand. With £1.2 trillion of UK defined benefit pension liabilities yet to transfer, this massive influx of capital allows Standard Life to compete for jumbo schemes they simply couldn't underwrite alone. It's a highly efficient way to scale capacity without diluting core return on equity, all while retaining operational control. Deal 4. Stone Point Capital. Turning to specialty distribution, Stone Point Capital acquired Ever.Ag's risk management business to build an independent agricultural platform.
What makes this move highly uncommon is the strategic trifecta. They're combining crop insurance placement, commodity derivatives brokerage, and risk advisory services into a single, dedicated specialty distribution platform. Navigating completely separate regulatory frameworks to combine these is something very few competitors can pull off, and it creates a formidable moat around agricultural risk distribution.
Deal 5. Marco Capital. In the London market, Malta-based legacy consolidator Marco Capital agreed to acquire Pro Global. This move reunifies Pro Global and PoloWorks into a 1,400-person insurance services powerhouse. It creates an entity fully capable of serving the largest Lloyd's syndicates across the full life cycle of their operations, drastically expanding Marco Capital's footprint in one of the world's most vital insurance hubs.
Marco Capital is brilliantly pairing the lumpy, capital-intensive nature of legacy runoff acquisitions with a smooth, recurring stream of outsourced services fee income. It fundamentally changes their revenue profile, buffering the inherent volatility of traditional runoff transactions with highly predictable cash flows.
Deal 6. Alliant Insurance Services. Finally, established distributor Alliant acquired Nava Benefits to pull an AI-native employee benefits platform directly into its infrastructure.
The efficiency gains driving this are staggering. Nava's proprietary AI platform resolves 81% of member support inquiries autonomously. This fundamentally alters the long-standing industry trade-off between high service quality and low cost. Alliant bought that arithmetic change outright, acquiring a proven technological advantage rather than spending years trying to build it internally.
synthesizing this week's rapid-fire transactions, we can see that mature players aren't simply acquiring revenue, they're utilizing immense capital to gain proprietary control of underlying technology and specialized distribution layers. The overarching theme is buying the exact infrastructure that will define the next decade of underwriting and distribution.
From acquiring continuous telemetry to autonomous service resolution, the strategy across the board is declarative. Mature players are buying proprietary control, and they aren't hesitating. The capital is precise this week.